Hello, WestCon 2020 in this virtual environment. Thank you so much for joining us today and your interest in learning what we're going to present for the 3 C's. My name is Jackie Ferenz and I'm with Avalon Risk Management. And the C that I'm going to be discussing today is trade credit insurance. I'll be going over what it covers, the benefits of the coverage, and then also to talk about pre-COVID economic concerns that were about from a global standpoint. And then to what we're faced with today with a global pandemic and how it's impacting businesses. And then as far as the insurance company that are insuring credit, what is their response in underwriting as part of this recession? And then lastly, just providing some business considerations that you can maybe look into. So trade credit insurance, it's otherwise known as accounts receivables insurance, for short, credit insurance. And it protects a company's bad debt. If your customer doesn't pay, is a very slow payer, if they completely default, they become insolvent, if it's due to you're working with a foreign company and there are, there are risks, political risks that are making it so that you're not getting paid, those are all areas that will activate the coverage and indemnify you for bad debt for your customers, as long as your customers are scheduled onto your policy. For right now, there are no pandemic exclusions that we're aware of. And then the waiting period to turn in a claim is usually 3 months from when the bill was due. And then you turn in the claim, the credit insurers, they're very prompt at paying you. And then they go out and they mitigate. They go after your customer aggressively because that's what they do. And if they're successful collecting any funds back, then there will be a percentage that will go towards your loss that was paid out. And so that's beneficial for your loss ratio. And then the overall amount that they pay is between 75 to 90% of the bad debt. You can consider that 25 up to 10% that you are self-insuring as your negotiated deductible per claim. So policyholders, I mentioned it quickly that your customers, if you have this program in place, need to be scheduled on your policy with known limits of what the insurance company is going to cover in the actual receivables. And then in turn, what that's going to allow you to do is understand how much credit that you can extend to your customers. The program itself, on a daily basis, it's continually running analytics of all of your customers, checking their creditworthiness by their financials, where they're located. Certain countries are higher risk from a global standpoint. Certain business sectors, industry sectors can impact what limits can be afforded that the credit insurer is willing to take on and insure. And the financial wherewithal of the buyers that you have scheduled, if they start to go south, the credit insurer at any time can change that limit and reduce it. And you will be notified, so it's a safeguard on your end, so you can proactively restructure how you're going to work with that customer. And then worst case scenario is if there's fear of insolvency, the risk is too bad, the insurance company is going to get off the risk altogether and cancel for that particular customer. So keeping that in mind. So the benefits of trade credit insurance is it can offer credit terms, that are flexible and protect your bottom line, which is your cash flow. On average, companies, the actual asset, the actual capital is their accounts receivables up to 40%. That's a lot. And so protecting that is what you're doing, obviously, with this type of program. It takes out the guesswork of, in absence of this type of program where you're trying to figure out how much credit to extend And, maybe, especially right now, it's, really a hard thing to provide, and, trying to figure out on your own through, credit apps and referrals, or, hiring a third party, to check it, the credit risk, and just giving you a snapshot. Well, what happens 3 months, 6 months down the road? Are you still monitoring it? By having this program, it's monitoring it for you. And it can turn around limits really quick, which could be a sales advantage. And certainly for sales growth, because for customers you have no idea, you don't even know them, and you got a salesperson chomping at the bit. Oh, we got all this transportation, and we can clear all their entries, and they got to extend this much credit because of all the volume. Well, you can run it through the old credit insurer tree, and then know what limit and sleep better at night as a result, and potentially win that business in comparison to trying to figure this all out on your own, administratively speaking, in-house. So something you may not be aware of is that policyholders can use their insured receivables as collateral for a bank to extend credit to them. So for small, medium-sized businesses, this is really attractive, where maybe the margins are thinner. If they insure their receivables, they're protecting their company, less likely to get burned. So for obvious reasons, the banks really favor that. And the result will be that reduced rates, better terms, and then, it frees up the business's bad debt reserves, since you're insuring the receivables, right? So yeah, any company that sells goods or services and provides, extends credit to their customers that are purchasing from them that are 3 million in sales or greater are really ones that are going to benefit from this type of program. And, right now in the US, 60% roughly are small to medium-sized businesses that are really utilizing this program. 14,000 suppliers also, more than that, are utilizing this program and really value it. In fact, certain industries such as the automotive industry and the retail industry, there are certain manufacturers and suppliers that will not do business with a buyer unless they can show proof that they are insuring their receivables. And the reason being, we'll just take like export shipments and, a sizable invoice for, transportation services. And, here you're extending based on all this transit volume. And on the other end, little do you know that that business that you are providing these services, that they got hit with bad debt and they don't have the financial wherewithal to recuperate from, extending their own credit to somebody. And so they're not going to pay you. Well, the way you can protect yourself is the obvious through this insurance. So pre-COVID and global economy, concerns for sure. And there's a association called the International Credit Insurance and Surety Association, and it comprises of 95% of all credit insurers from around the globe that insure receivables. And what they found based on the findings of the members is definitely there was a surge in the 2018, the demand for trade credit insurance. And it was concerning because it was an uneven economical outlook. It's mirrored because of so many businesses suddenly wanting the coverage. And so in 2018, the insured exposure for receivables amongst all the insurers grew by 8%, which totaled out in the given year over $3 trillion. And then the premiums increased by $6.7 billion in one given year. Yet the global economy only grew by 3%, and those findings in 2019. And it's at the lowest rate since 2009, which was when we had our last global huge recession. So again, concerns And then we are struck with a global pandemic, which is COVID. An economy crisis. It's not funny, but the cartoon's kind of cute. Anyway, one of the leading insurers is Euler Hermes for this type of insurance. And just for you to know, if you go on their website, they have a lot of really valuable information as economists. They have to be, and they put out white papers on a constant, basis every couple of months as they forecast our global economy and risk. And so they put out this information about this survey called Risky Business, and they randomly selected 250 U.S. CFOs. 50% were under, 50 million in annual revenues, sales revenues, so smaller, and then the 50% was larger businesses to make a balanced, survey. And what they'd asked, one of the questions was, how has COVID-19 disrupted operations? 50% had said, it's made significant cuts in staff and other expenses. And then the other, 42% had said, we have had major cash flow disruptions. So, speaking of which, Euler Hermes also has forecasted recently the bulk of insolvencies are going to be hit at the end of 2020, and you can also, for Q1 of 2021 is where you're going to see a surge in insolvencies. It's supposed to rise in comparison to 2019 insolvencies filed. It's going to rise additional 47% 2020 versus 2019. And the GDP is going to shrink by 5.3 in 2020, which is the worst since World War II. They're expecting, in 2021 to be some, pickup growth back, but it's really hard to know what's going to happen. As we all know, like this COVID resurgence in the fall that they were afraid of is happening. So a lot of uncertainties. And then, as far as insolvencies go, retail is going to be the hardest for sure. And I'll show you why. Here is the first half of 2020 and the sector and size of large companies that have already filed, to be insolvent. Retail is the first one on there. And the lighter the blue is where it's like 50 million to 99 million. The darker the blue, the bigger the company. You can see here too, you've got services. Let's go back. Oh, well, I can't go back for whatever reason, but there's sectors such as services, energy, and automotive and metals. Those are the top ones that are really hurting in insolvencies, big business. And then here, this one, it shows insolvencies by 2021. The top country that they're expecting a increase from 2019 to 2021 is an increase by 57% is in the United States for insolvencies. That's just crazy. Anyway, and then it goes down the line to all these different other countries. Major business insolvencies create a domino effect, as you know. The larger the company, the bigger the impact. It disrupts the supply chain. Companies then have to find other suppliers that they never had partnered with based on the urgency of what they need. The demands and supply. It's going to maybe be more costly. And, the ones that are going to, possibly get burned that aren't insuring their receivables and, get hit with the bad debt. It's like the trickle-down effect and not a good one. The course of this pandemic, we all know. We don't know. That's one thing we know is we don't know, right? The duration of the lockdowns really impact the businesses. The longer they lock down, the higher risk for insolvencies. The governmental incentives that are being placed for businesses, it's very likely that a lot of companies are going to, still not be able to survive because they're barely scraping by. and, by using the loans. And then, the ability to actually file insolvency cases across the globe. If you can't go into these offices, and then also too, administratively speaking, how many people do you have that's going to be able to support the surge of bankruptcy filings? So we may see a lot of delays in the actual filings, which will give it kind of a skewed look of what's really going on. So keep that in mind. And then, of course, don't need to say it, political disruptions, not just in the US, it's everywhere. So the impact on the actual insurance companies that are insuring these receivables. What you can expect as a policyholder is they need to cut their exposures, because this program, you can see all the advantages on, when everything is back up on its feet in a much better level as far as the economy goes. And so what they're going to do, and what they're doing, is they're going to, be scrutinizing the underwriting. And then too, the high-risk industry sectors, the companies that are really struggling or are known as far as industries that are going to be really hit, they're going to take that in consideration. And what they could be doing is, depending on who you're working with, is cut credit limits across the board, just reducing the overall limits, or getting off the policy altogether and not insuring altogether. Now, how does that impact companies? Well, then, if you reduce credit limits, then you were insuring and you were using that as collateral for your own credit line, the lenders are not going to like that, and they're going to reduce your credit line as a result of that. And then, too, is these companies that really rely on the protection. And then, depending on how the coverage is limited, it could create more high risk of, in their sector of business, of working with companies that they're not sure about the financial wherewithal. So bad debt reserves may need to grow to provide that cushion. And then supply chains significantly are going to be reduced if you think about it from the retail side, and that their retailers, the small pop, the medium-sized guys, they're really suffering. And, manufacturers and suppliers, can they afford to, still do business with those ones that are suffering, or go big box and, have the companies then, purchase their goods that are going to be able to survive this financial, economical recession? That's something that'll be considered. So what can we expect in the future? I don't know. Crystal ball, right? We will rebound. It's just a matter of when, right? Changes that businesses can do from a risk strategy, for future crisis and this current crisis is, considering offering more restrictive credit terms, insisting prepayment deposits for new risk buyers, explore mitigation, risk mitigation and products such as trade credit insurance. Now that if you haven't learned before, now you know all the ins and outs of it and the benefits of it. And just rethinking overall expansion. Growth may need to wait. For manufacturers, inventory, and making new inventory, maybe holding off on that. Maybe holding off if you can survive in who you sell to, if your whole book of customers can't get credit insurance. And it's getting really scary depending on the sector. And you better believe in retail, that's a major one. So with all that being said, I miss you, WestCon folks. I really can't wait to be able to personally see you all and not have to be videoed like this and present in person. And thank you so much. And now you'll be seeing Dieter Hudson and what she's going to speak on. Take good care. Thank you. Bye.